Hello, everybody. Welcome to Intermediate Accounting. My name is Bennett Tchaikovsky. I'll be your guide and host today. Today, we're going to be overviewing equity. So in terms of going into owner's equity, I'm going to be linking some of my other videos that I've kind of gone through and have done. But when we kind of go through and look at the equity section, best thing for us to kind of go through and do is to look at, different basically different companies that are publicly traded that are out there. And maybe kind of a place for us to kind of go through and start when we're looking at this is to kind of discuss, how do, companies kind of go through and control themselves. And what I mean by this is, for example, if you go to, for instance, if you go to Meta Platforms, and if we were to go through and look at Meta and how its corporate structure is done, what you are going to notice is that they have Class A, which are the ones that are publicly traded. And then they have Class B shares, which I do not believe are publicly traded or registered. And when we look at these kind of particular shares, in terms of what's actually going through and being covered. I believe it only covers Class A shares, but what are exactly our Class B shares? Class B shares essentially hold, I believe it is 5 times the voting rights of Class A shares. What does that mean to someone who is investing on, in Meta Platforms? Well, there's pretty much no way that someone is basically going to be able to vote out Mr. Zuckerberg out of office. And just give me 2 seconds here. And here you go. So you've got over here, our Class B common stock has 10 votes per share. So when you look at Meta Platforms, from a perspective of, this is really about ownership control and, how, like, why does someone like, like Mr. Zuckerberg, why did he choose to have like this structure basically in place? Well, Mr. Zuckerberg did not have to take Facebook public. That was not something he had to do because I believe that they have been profitable since inception. Um, Not the movie Inception, but from when they actually started out. I and so by having Class A and Class B shares, if these in fact do have 10 times the voting power, and Mr. Zuckerberg owns the majority of these, then he basically has three basically 3.4 billion votes on, and that basically means that he can outvote any other shareholder. And when you look at Meta Platforms in particular, is, why is it that, why would anybody invest in this type of company? Well, it was fully and fairly disclosed in their registration documents that if you were investing in Meta Platforms, you were never going to be able to control it. Now, why does this kind of take place? It's like, well, if we look at Steve Jobs was famously voted out of Apple. And how did that happen? Well, he lost control. And so what you're going to find is today is that many founders are going to basically set up equity structures prior to them going public where they'll be able to maintain control. Now, this is always going to be essentially a component of how much leverage or how much negotiation power do you actually kind of go through and have. So from an accounting standpoint, when we're looking at equity, right, obviously there's common stock. But within that common stock, we're really looking at there's a lot of different types of, you've got Class A, B, and C. And again, this is really allowing those founders of the company to retain control. And from a corporate reporting standpoint, as long as we're going through and, as long as we're going through and basically mentioning this to our potential investors, it's absolutely okay to go through and to do it. Now, one of the other things over here is that when it comes to just some kind of basic overviews, when it comes to corporate law that we have to kind of go through and follow, this is really going to be a matter of state law. And if we look at Meta Platforms, it is formed in Delaware. Now, if we look over here, they're located at One Meta Way in Menlo Park. Oh, we've got a cat about to Zoom bomb us, so I'm going to do a Melon Porter and not say get out of my shot, but Ozzy, I want you to come into my shot. There we go. And we're going to say hello, Ozzy. We'll do like a little kitten break. Yeah, look at that kitten break. Wow, that's like awesome. I'm gonna just hold on. Let me just stop my screen share here. Ozzy, do we want to have any words for the audience of the accounting professor? Are you having a perfect day today? Something like that. Yeah, there we go. Okay, there we go. And you're gonna sit right on my keyboard. That's even more amazing. So thank you, Ozzy. There we go. Yes. Okay, so now coming up back over here to looking basically like at Meta Platforms, right? So it is a, it's a Delaware, it is incorporated in Delaware. It is incorporated in Delaware. However, at the same time, if we go to the California Secretary of State, where all corporations have to register, it is also registered in California. And it will be registered as what we call a foreign corporation. Does not mean it's overseas. That would be an alien corporation, not Alien Romulus or Alien versus Predator, but just an alien corporation. And so when you have that, we would say that Meta is domesticated in Delaware, and then they are, whatchamacallit, they're domesticated in Delaware, but they are a foreign corporation in California. Now, the other kind of thing to remind ourselves of is that if you're going to sue Meta Platforms on corporate matters, you're going to do so in the state of Delaware. If someone slips and falls at the Menlo Park facility, God forbid that happens, then that's also going to essentially be, that would basically be that would be happen in California. That would not happen in Delaware. So that's kind of a difference between, that's foreign, alien, domestic corporations. And then just kind of some other things to kind of go through and kind of look at. And the one thing you'll see over here is that you'll see this fractional par value. And what exactly is par value? Well, par value is the minimum amount a shareholder is responsible for. So even though the CPA exam and, the widely examples will use a higher par value, you would probably be committing illegal malpractice if you saw a par value like this, right? Because what you don't want to see basically happen is that if, someone basically, if the shareholder, when they buy shares, they're really saying, okay, I'm at risk for my investment. The investment can go down to zero, but that's all I really want to kind of go through and be responsible for. I don't want to have to basically put in more money other than my investment. I may lose my investment, that's okay, but I don't want to be losing anything more. So we set par values very, very low. Now, what's an example of a company that has a really high par value? And that would essentially be like Berkshire Hathaway. And if I were to go through and to look at Berkshire Hathaway, what you're going to notice is that basically, okay, I'm going to do a little quick search. Just give me a moment. So if I look at Berkshire Hathaway, right, Berkshire Hathaway has a $5 par value. And now you might say, well, Bennett, like Berkshire Class A shares have a $5 par value, so your theory is debunked. I thought it was always going to be a fraction of a penny. Well, if you look at Berkshire Hathaway, you're basically going to see a value of $713,000. Now, why is that $713,000? It is because the company has never, ever done a stock split. They've never split their shares. And so what's happened is you kind of see that the value of this thing goes up and up and up. Now, with new trading platforms and being able to kind of go through and to uh, being able to kind of go through and to trade only 219 shares traded, but with new trading platforms where you can basically go through and buy and sell fractional shares, it may be, something that, you could buy a share of maybe like a fraction of this, but, again, you just have to kind of look at to kind of see what's going on. So we're going to typically see a very low par value. And when we see with most companies, what you're going to see in terms of their financial disclosures is you're basically going to see things listed out basically over here as basically as par, right? Which is the minimum amount that has to be paid. And then the remaining that something gets paid for a share of stock is going to go into additional paid in capital. Right. Again, I have a lot of videos on this that if you want to kind of go through and to look at it, absolutely something you can kind of go through and do. Now, the other thing I want to show you here is that we're also going to see a lot of things in equity when we're looking at, you'll see preferred, and you're going to see things like preferred stock, convertible, non-convertible, all those types of things. And really what I want you to kind of think about any kind of security is that really this is going to essentially be what the investors or the company is going to be able to dictate, right? So when we look at Snap, right, and this is when they were originally going through and formed, they basically had a variety of different shares of stock happening to be one of them. I'm fun with Ozzy until my son comes home, and then I don't stand a chance. So when it comes to preferred stock, and we'll see this in some examples of like convertible, like all that kind of junk. From a publicly traded company standpoint, it's really about like, once a company goes public, and in my experience, is that the SEC, what if a company is going public, they generally only want you to have one kind of stock. And basically that would be essentially would be common stock. Why does that kind of take place? Well, the reason is because like preferred shares will oftentimes carry liquidation preferences. So you see this over here, liquidation preference. So if the company does go bankrupt or if they liquidate their assets, they'll basically get paid prior to the common shareholders. So typically what will happen is that Snap, when it went public, I believe between December 31st, 2016 and March 31st, 2017, you'll see that, oh, this is convertible, 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 right? It's not the top that's coming down, but rather all of these shares converted into common stock upon going public. And so this is something that's very, very typical of, with SEC companies. Now we will see examples of like, as we're going through it and doing some of the exercises and the Wiley questions, we will see examples of like, oh, convertible, non-convertible, cumulative, non-cumulative dividends and all the other kind of fun stuff. But for purposes of, publicly, traded companies and financial reporting, this is something we'll kind of, that generally when a company goes public, we'll just kind of see just regular common stock. And again, those can be put into different classes depending on their voting preferences. Let's look at what else is in equity. So additional paid in capital, and just to kind of give you like a really basic example of this and kind of just keep it really simple, is that if I went through here and I basically said, okay, YYZ issues 1,000 shares of common stock on 1/1/2026. The shares had a par value of 0.001 per share. And let's make this a little bit different. Issues 10,000 shares of common stock on 1/1/2026 for $15 per share. The shares at a par value will make this 0.001 per share. Prepare the journal entry to record the transaction. And, this is financial accounting, not intermediate accounting. But as we go over here and we look up, basically, if we look at this and we look at our friend, which is basically going to be Our assets are equal to our liabilities plus owner's equity, expenses, revenues, debit, credit. What we're going to find is, well, when we go through and do this, basically this particular transaction is that we're going through and we are receiving cash. And how much cash are we receiving? Well, it's going to be 10,000 times 15 or 150,000. Now that's how much cash we're receiving. Okay, so this is going to be 10,000 times 15. Now, when it comes to the other side of the equation or the equity side, well, how do I account for this? The first thing we're always going to do is we're going to basically do the shares at par. So we're going to have common stock at par. This is going to be 10,000 shares times 0.001 per share. So this is going to be 10,000 times 0.001 or $10. Now, we always assign it to par value first, and the rest is going to go to APIC or additional paid-in capital common stock, which is essentially going to be the difference between these two amounts right over here. So this is how we're going to go through and record this transaction right over here on 1/1/26. If we're to do this as a journal entry, we basically have got cash at 150. We've got common stock at par over here for 10. We've got additional paid-in capital stock over here for 149,990. And this basically, I always like doing the T accounts first because basically these come essentially from, basically this comes over here from the journal entry. Basically, this will come in from the T accounts. Okay, right over here, speak basically to record common stock issuance. Okay, so that's I think I'm probably spelling this incorrectly, but that's okay. Okay, so that's how I'm going through and dealing with, I'm first going to go through and assign it to when I show the cash being received, I assign the first amount over here to common stock at par, and then the difference is going to go to additional paid-in capital common stock. So that's how I go through and record a basic stock transaction. One of the things you might also see too is that if on 1/1/25, YYZ was founded, um, and basically over here, basically was founded, and I basically we could say, we'll say 100,000 shares were issued to its owners for par value. Okay, and when you see the Jeff Bezos and you see you'll sometimes see this kind of come up where Congress will get really upset at people like Jeff Bezos and why do they get so mad? It's like, well, when Amazon was founded, it had no value. Well, it did have value, but in the perspective of the markets, it had no value because it was a privately owned company. And at that point in time, when you found a company, you can basically issue yourself shares at par value. Just if I form a corporation, nothing's going on yet. That's absolutely fair to do. And then when that value grows, it's essentially not going to be taxed until you have some sort of like a liquidation event. So, like, if I was going through and doing this over here, then my cash would obviously be here at. So basically, I'm getting cash of $100, and then at the same time, I'm basically going to be recording common stock at par for 100, right? Because that's going to be 100,000 times 0.001, which is the par value per share. So I would just basically, if that happens, that would basically, and that's perfectly legitimate and legal to go through and to do. Okay. So let's kind of go back over here and kind of take a look at just some other kind of topics. So again, when we look at, why do we have different classes of stock? It's really about control. And just think about how Steve Jobs got ousted out of Apple, and he had those things in there, that would not have happened. Just some other things when it comes to investing, and just you always want to. The thing you really want to watch out for is who are you doing business with? Check Glassdoor, check, do your diligence checks. If they're a broker dealer, look at FINRA. When you take money from an investor, you kind of have to know who is that investor and where is that money coming from. Very important to do because it's like, that's just going to dictate a lot of, things that are going to be happening to you over time. But always do your diligence on investors, check the FINRA for the broker dealer history. You really want to be aware of toxic debt instruments. I saw one time where someone borrowed $1 million and it was a 5 times promissory note that had to be repaid with $5 million. Toxic debt, this kind of debt can basically make it almost impossible to raise capital in the future. And the other thing to also really remind yourself of is that cash flow is by far the most important thing for any kind of a startup business. Well, let's kind of go ahead and kind of continue to look at equity. So as I kind of mentioned, some of these different parts is that you've got these different forms of common stock, preferred stock, and then no par stock. I've never seen it. Um, I've always seen some kind of like common stock being issued. I just don't see it. And again, it's really going to be on the investor. A lot of times investors will want to loan money that is convertible because then they're getting the best of both worlds. They're getting, not only are they getting, not only are they getting debt, but it's convertible debt. And that can also have its own natures of being toxic. So just kind of keep that in mind. And when you go public, and this has obviously kept me employed for a while when companies do go public, but why do companies go public? It's really investors are looking for an exit strategy from their investments, because if you are investing in a private company, you can't really get the money out unless you're going public or you're going to have some sort of a liquidation event. You either sell the company or you take it public. You can have some like market favorable conditions, like now it's going to be like hot sectors like artificial intelligence. Requirements to go public are very, very extensive. You have to have books that are auditable. Filing an S1 registration statement with the SEC. You're going to hire experienced investment bankers. Sometimes you may hire investment bankers that are not as high tier. Again, it depends on the company and the situation you're in. But again, when you're going public, you're also going to want to make sure that you have strong internal controls, especially depending on how large you are as a company. And it's also very risky. It's like you're essentially opening yourself up to the world. But again, for certain companies, it can actually kind of go through and make sense. Now, here's some different kind of terminology that we want to kind of go through and look at. And the best way, or the one I generally kind of, defer to, is our friends at the Home Depot. And when we kind of go through, and this, I think is going to serve as like a really good example. But when we look at this over here, you have common stock. Let's kind of break this down. Okay, so So here we got the Home Depot, and you see over here, par value is zero point 0.5 cents, authorized 10 million shares, 10,000 shares. Now, when we look at the depot, right, basically, when we look at this over here, amounts in millions, except for per share data. Okay, and that basically is referring to the earnings per share. But when it comes over here, these amounts here our amounts are in millions. So when we look at this, basically you've got, 10 billion shares authorized. Okay, so when a corporation initially forms, okay, they're basically going to say there's going to essentially be the articles of incorporation. And if I just did a quick search here, let's see if I can find this. Let's see. Okay. So as we see over here, like basically when you have like the articles of incorporation, and this is obviously was done as we're looking at the date on this, this is like in 2011. But when the Home Depot started, I can probably say without, saying anything, is that the authorized shares were probably well less than 10 billion. No way in your right mind would you authorize that many shares when you're first starting out. You can always go through and, basically change that later. But what exactly does authorized shares mean? So I got 10 billion. Okay. So basically we've got 10 billion shares authorized. What this basically means is that the corporation has the authority to issue up to 10 billion shares. Okay, so when we're choosing an authorized amount, we want to make sure that we have like enough of a gap so that between what's happening, like basically so that we can issue more shares. Now we can always go back and amend our articles of incorporation. Look at this over here. So when we form a corporation, we file a articles of incorporation, but what we can do later is we can go through and amend them. So we can essentially go through and say, well, I had 1 million authorized shares. I can now change that to 10 million. I can change that to 20, whatever it might be. Now, the state I'm operating in may charge me more money as a franchise tax, which is why most companies will not increase that until a period of time. But, there you go. So when we look at this, the authorized shares, when someone incorporates, they'll say, okay, we have this many authorized shares. From our perspective, there's no journal entry when this happens, right? Because we're just kind of saying it's going to be more of a disclosure, right? So if I look at Meta, for example, and I look at this over here, this is the amount of shares authorized. It's a disclosure, right? It's not anything but that. And so when I come over here, right, to basically to this part, so this is just the number of shares that I authorize. Now, once I go ahead and I start selling shares like what we did up here for YYZ, right now I've got 10,000 shares outstanding, right? So what's going to happen now is for the Home Depot, excuse me, I'm going to have 10,000 shares issued and outstanding. So let's go ahead. So issued, and then we're going to start over here with outstanding shares. So for our example here, if I said YYZ had 1 million shares authorized. Okay, so, and if we basically said here, authorized, issued, outstanding, right? My issue here, we also had this issuance over here of 100,000 shares. So I'm going to have issued and outstanding shares. This is not really changing. It's still going to be 10 million authorized, but the next year or in basically the following year, I'm issuing basically 10,000 shares. So when you look at this, what exactly does this, when we see the term issued, that essentially indicates how many shares I have issued out and sold to investors. Now, that's issued. What does outstanding mean? It basically means of those issued shares, how many have not been repurchased by the corporation? And that's basically the definition of what we call treasury stock. So let's take a look again at Home Depot a little bit more carefully. So when I look at this over here, you're going to see 1.8 or 1,803 or 1.8 billion. They have this many issued shares. Okay, so this is the number of shares that they have actually issued. But at the same time, the outstanding shares are basically 997 million. And you might be wondering to yourself, well, wait a second. Why is that difference there? Why is there this difference here of roughly 806 million shares? Well, what this essentially means is that the Home Depot has gone out and they have repurchased basically stock, basically in there. They've basically gone out into the open market and they've been buying back their own shares. And so this is what we call the definition is basically as treasury stock. And if we look at this here, you'll basically see that treasury stock at cost 806 shares at May 3rd, 2026. That's basically, they have repurchased over time 806 million shares of stock. So, wow, that's a lot of shares. They literally are swallowing themselves by having repurchased almost 44% of the stock that they previously issued. Now, one of the things is like, well, why did that number kind of stagnate, right? Why is this just showing that they spent $95 billion repurchasing their own shares? Now, why did that kind of stagnate? Well, debt, right? So right over here, the Home Depot carries $44 billion of debt. Well, since time has been going on, borrowing money gets to be really expensive. So more than likely, what they were doing for a long time is they were essentially borrowing money, doing a lot of share repurchases. Why do companies do share repurchases? Is because we'll see in the next chapters when we're focusing on earnings per share, essentially you're going to be raising your earnings. And why is that? It's basically because, well, if I have fewer shares outstanding, because the EPS or earnings per share is based on shares outstanding, right? Then my earnings per share goes up. So by buying back my own stock, I'm effectively taking the net income divided by the number of outstanding shares. I'm reducing the number of outstanding shares. So that effectively is increasing my earnings per share. So let's just kind of go through and kind of building on some of the examples like right over here. So that's essentially like the definitions over here of authorized, issues, and outstanding. And just to kind of comment a little bit about, some of the other parts of essentially of the different components of the balance sheet or owner's equity. And the one I'm going to kind of show you over here is of Apple. So if you took the first semester of intermediate accounting, what you hopefully went through and did is kind of explored a little bit of something called comprehensive income. And when you see what exactly does that mean, it's like, well, if I come over here, I've got net income. And then below this, I see this comprehensive income. What does this mean? Well, basically what it is that when you have things like when you're translating financial statements from like one currency to another, because those exchange rates change, you're going to come up basically what we call like foreign currency translation gains or losses, but they're really not. They're really more of like balancing entries. So what we end up doing for Apple is you're going to see this component of their balance sheet called accumulated other comprehensive income or comprehensive loss. So effectively, what is kind of happening here with Apple is that you see this, well, wait a second, they've got an other accumulated like loss, like, well, what's going on with that? It's really because of things like foreign currency translation gains and losses. Now, the other type of this is too, is you're going to see that on the balance sheet when we have non-current marketable securities, when we have basically when we have these, there's you have to show from a financial reporting perspective, we have to go through and show our securities basically at their market value. when we do that, it's either going to trigger a gain onto the income statement under certain conditions, even if we're not selling it, or it's going to be, we just have to basically update it, which will then go into comprehensive income, which is not net income. It's rather something we're kind of going through and using basically to balance out our financial statements. So when we look at a statement of owner's equity, right, I'm assuming all of you are familiar with retained earnings. It's our net income, our beginning retained earnings plus our net income minus our dividends, easy lending. When you look at that, it's kind of like, well, yeah, it's just, you kind of go through and see that it's like, okay, that's retained earnings, right? So when we look at the components of owner's equity, you really kind of see it's like, okay, we've got, basically that retained earnings component. And then you've got the accumulated other comprehensive income and loss. So remember, with retained earnings, this is basically the earnings of the corporation that we're going through and keeping. And this is over here for Meta Platforms. And then you have over here, you have the other accumulated other comprehensive income or loss. Now, one of the interesting things that I've kind of noticed is that you'll see companies that when it comes to Treasury stock, is that they will retire it, but companies will go through and retire it against retained earnings. I'm not going to make a video on that, but I'm just kind of pointing this out just because I want you to kind of go through and to be kind of aware of it. So as I'm making this video and violating every rule of YouTube, let's just kind of go through a quick Treasury stock example. So let's refer back up here to, so YYZ on 3/1/26, repurchases, 200 shares of its own common stock at $10 per share. So the first thing I want to tell you is that when a company buys back its own stock, why do they do this? Well, as I kind of showed you with the Home Depot, it's to kind of boost up that denominator and basically get a higher earnings per share. But it's also, well, if I give a dividend, that may not be as advantageous as just going out and repurchasing shares. Companies do things for different reasons, but again, it's kind of like you're swallowing yourself. So when it comes to Treasury stock, the way this is going to work, and again, always use T accounts, but when I look at this over here, so I'm repurchasing 200 shares of my own common stock for $18 per share. Well, we know that cash is going down because I'm basically spending $360 to buy back my own stock. Because if cash is an asset, we're going to decrease that asset with a credit, right? So, but what do I go through in debit? Debit Treasury stock. And this is going to basically be over here for 360. Okay, so that's kind of what's happening right over here. Now, the next example I would tell you is that, I'm not going to do the journal entry, but why does Treasury stock have a debit balance? Well, it's not a contra equity account. Rather, what it is effectively doing, it is reducing the amount of owner's equity. So like right over here, when we see Treasury stock for the Home Depot, you're seeing basically a negative number in equity. And that's, well, why does it have a negative number? It's because traditionally, when we look at owner's equity, it is going to have a credit balance, right? A LOE, right? Owner's equity traditionally has a credit balance. So when we look at this over here, that's why it's going to show up as a negative on our financial statements. Not a contra equity account. It really just is reducing the amount of equity outstanding as we bought back our shares. Now, if we go here on 8/1/27, Resells 30 shares that it acquired on 3/1/26 for $20 per share. So when it comes to this over here, what's going to happen is like, well, if I'm going, and by the way, when you buy and sell your own stock, you have to be extremely careful. Why do I have to be extremely careful? Because it is effectively insider trading. You have to go through and basically tell everybody it's like, hey, this is what I'm kind of going through and doing. So our treasury stock had a balance of 360 on 3/1/26 or 12/31/26. And over here, I'm reselling 30 of those shares. So how do I go through and do this transaction? Well, I'm going to be debiting cash for 30 times 20. And at the same time, I'm going to credit treasury. Basically, I'm going to be going through, sorry, treasury stock has a debit balance, Ben. Good job. So this is going to be on 1/26. Okay, so this is our initial balance. So over here, I'm going to credit treasury stock. Now, when I credit treasury stock, I'm not going to do it for the full amount. Rather, what I'm going to do it is for what did I originally pay for the shares. So over here, I basically paid originally for these 30 shares, I paid $18 per share. Okay, so this is going to be $5.40. Now, the problem I have at this point is I've got a debit to cash, basically a credit to treasury stock over here for sorry, this is wrong. Okay. So as I'm coming up, sorry about that. I basically made an addition slip up. It's my fault. This should be 200 times 18. And we all make mistakes. So let's go back to this. I repurchased 200 shares of my own common stock at $18 per share. 200 times 18 is $3,600. Then a year later, I'm reselling 30 of those shares that I acquired on 3/1/26 for $20 per share. So I'm receiving cash of 600. And now when I go to credit treasury stock, I'm basically doing this over here for $18 per share. Now, when I buy or sell my own shares, I cannot recognize a gain because it would essentially be self-dealing. So what I'm going to credit is additional paid in capital treasury stock effectively over here for the difference for $60. So that's what I kind of go through and do over here when I am reselling treasury stock at a gain. I don't record a gain, rather I'm going to use additional paid in capital treasury stock. Okay, now, the next thing I'm also going to kind of go through and look at over here is to say, well, YYZ on say 11/1/27 resells 50 shares that it acquired on 3/1/26 for $8 per share. So, by the way, I'm just going to show you something really quickly just to kind of the importance of cash management. So Pier 1 Imports, they went bankrupt in 2020, but the reason why I'm kind of showing this to you here is that Pier 1, if we look at their financial statements, when you have one of the things that they had over here was basically they have been going out and they have been repurchasing their own shares. And the danger in doing this is really like you are using company cash to go out and reacquire stock. So that basically means if you're spending money on dividends or acquisition or buying back your own shares, that's less money that the company has to go through and spend. So when we look at Pier 1, here you've got a company that had all this treasury stock that they spent 586, these are in thousands, $586 million on buying back their own shares. They later went bankrupt. This is more kind of a cautionary tale for you when it comes to treasury stock. But again, a lot of companies buy back their own shares. It's just something for you to kind of go through and think about. Well, let's go back over here to YYZ. And when I look at YYZ, I would sell 50 shares that I acquired on 3/1/26 for $8 per share. Now, before I go through and do this, let's kind of do a little bit of an update of where our Treasury stock stands, right? So on 3/1/26, we had an initial debit balance of 3,600. We sold basically, we basically lowered our Treasury stock by 540, or the 30 shares at $18 per share, which is what we had originally bought this back on. So this is going to be on 8/1/27. And then additionally, we had, no pun intended, we also reported additional paid-in capital common stock. Okay. So we recorded additional paid-in capital common stock, and that amount over here was 60 on 1/27. Now, when it comes to doing the new transaction, right? First thing we always do is to say, okay, how much cash did we go through and receive? Well, we sold 50 shares at $8 per share. Or basically getting over here at $400. So this is going to be 50 times 8. Now, when it comes to recording Treasury stock, right, this is going to be 50 times 8, and this is going to be on 11/1/27. Now, when it comes to recording Treasury stock, I'm always going to go through and record this and what did I go through and pay for it. Well, originally, when I went through and did this, I did 50 shares times 18. Okay, so this was the sale that related to 11/1/27. Just to kind of clarify this over here, this was essentially 30 shares times 18 per share. So if I'm going through and kind of building a journal entry on this, I'm debiting cash on 11/1/27 for 400, right? And then at the same time, I'm crediting Treasury stock for 900, or what I originally went through and paid for it. Now, kind of the dilemma I have is like, well, wait a second. This to me looks like a loss, right? Because I bought it for 18 and I'm now selling it for 8. So I have a loss. Well, what we want to kind of, but before we can never really record gains or losses on our own stock. So what I'm going to do first is when it comes to doing this kind of transaction, is I'm going to basically look at the additional paid capital, if there is any, and I'm going to bring that down to 0. So on 11/1/27, I'm going to go ahead and debit additional paid capital, and this balance is now going to go to 0. So I'm going to have additional paid capital, Treasury stock, basically debiting this here of 60. Now, what do I need to do to balance one? You have 440 debit, and my inclination is to basically debit a loss, but we can't do that. So instead, what I'm going to go ahead and debit is going to be retained earnings. So this is going to basically be record sale of Treasury stock. So when it comes to Treasury stock, right, just remember it's stock that we're going through and buying back. We can never report gains or losses. If we have if we sold it for more than what we paid for it, we're going to use additional paid-in capital common stock. If we sell it at a loss, we're going to basically blow out that additional paid-in capital first, and then we're going to basically dump the rest to retain earnings. Now, the other thing to remind ourselves of is that, for example, if the Home Depot were to pay a dividend, right? Would they pay a dividend on the issued shares or on the outstanding shares? Well, the answer to that is, well, they would pay it on the outstanding shares. Why is it on the outstanding shares? Because they bought back over here, 806 million of their own shares. Why would you pay yourself a dividend? So when we're paying back dividends, we're going to be going through and doing that as well. Now, one other thing I would like to do with you before we go, and again, I know I'm taking a lot of your time. This video is going a lot longer than I thought. But the other thing I want to talk about is our stock splits, either forward or reverse. I will talk about stock dividends later, or I'll include a video link below. But when we talk about stock splits, why exactly does this happen? Well, if we say, when did Apple split its shares historically? So when we look at Apple, right, this is basically they've had multiple splits, but when you kind of go through a 224 for one, but I want to kind of show you is that the Apple stock price historically, and I want to look at the max amount of this, and I want to kind of go over here, especially to 2014. And if we go back in time to 2014, the stock was trading at basically at around 17 bucks per share. And this is adjusted, right? But it was actually the price of this was like much higher, it was like in the hundreds of dollars. So they split the stock. And when a stock split happens, right, essentially when we call it a forward split, basically if HD declares a forward split of 2-1, or we'll call it, let's do 4-1. Okay, so if I look at the Home Depot stock price and it's 313 bucks, the share price was 313. I'll call it 300 on the day of the split. Now, from a journal entry standpoint with stock splits, we don't do anything, but this is going to impact our authorized issues and outstanding shares. How is it going to impact this? If I'm doing a 4-for-1 split, I'm basically taking the authorized and I'm basically changing that. I'm taking away that one share and coming back with 4. So what this is going to affect do is I'm now going to have 40 million authorized shares. I'm now going to have, in terms of outstanding shares, this is going to basically also be multiplied by 4. And my issued shares is also going to be multiplied by 4. Okay, so we do a forward split. Okay, now with my shareholder, they owned one share, call it one share at 300, right? That's what they owned. Post split, right? They're now going to own 4 shares, but there's going to be a market adjustment. It's basically going to be 300 divided by 4, or basically it's 75 bucks per share. So when we have a forward split, this is what happens. Right now, when you have a company that, in order to stay on the NASDAQ or on the New York Stock Exchange, you have to have a minimum bid price of $1 per share. And if you fall below that dollar per share bid price, you will get a notice potentially of delisting from that exchange. And then you want to talk to your securities attorney. So what you may also see sometimes is that, and again, if this was, and I'm going to basically make this up, basically say now, well, we're not going to do, we'll use the same numbers, we'll call it Lowe's, declares a reverse split of 1-for-4. Share price was 50 cents. On the day of the split. Okay, so and by the way, when they do splits, they'll announce it and they'll say it'll be effective as of this certain date. So the market will go through and the exchanges will go through and make this adjustment. That's handled through the transfer agent. Okay, so when I come over here and I'm basically doing a 1-for-4 reverse split, but what exactly does that mean? Is like, well, I'm taking basically 4 shares away from that investor and giving them back one. So this is basically now going to be multiplied by 1/4. Okay, so it's again, it's a reverse split. And here my investor owned 4 shares at 50 cents pre-split. And now they're going to basically own 1 share at $2 post-split. Okay, so when we look at this and we look at both of these situations, right, the shareholder is basically in, if I'm a shareholder, well, I had 1 share at 300 and now I've got 4 shares at 75. Here I've got 4 shares at 50 and now I've got 1 share at $2. So I'm literally going to be in the same position, but these have very different meanings. Generally, what happens is when you start doing reverse splits, they smell blood in the water. It's the last thing you want to kind of try to go through and do. I've been I've been a board member of companies where that's actually happened. But again, it's just kind of something to just to kind of go through and think about. But again, that's the difference between a forward split and a reverse split. And the only thing I really haven't covered today in this extra long video are stock dividends. And I may be going through an example of that a little bit later on. But if I don't, I will include video links basically for this. So for those of you who have endured on this journey, I want to thank you for being with me here today. Please remember to like and subscribe, and I look forward to seeing you on the next video. Have a great day.